This decision won't ruin you tomorrow, but in 20 years it could cost you tens of thousands of dollars. If you've ever bought ETFs or index funds without fully understanding what you were buying, or without knowing which one is actually better for you, this video is for you. Choosing wrong won't hurt immediately. That's exactly what makes it dangerous. If you're serious about financial freedom, understanding this isn't optional, it's the first commandment. What's the actual difference? Both ETFs and index funds are baskets of stocks. Instead of buying one Apple share and hoping for the best, you buy a basket containing Apple, Microsoft, Amazon, and 500 more companies. Up to that point, they're identical. But here's where most people get confused. They assume ETFs and index funds are the same thing. They're not. Difference 1. How they're bought and traded. With an index fund, you can place an order at any time, but it won't execute until the end of the trading day at the closing price. With an ETF, you're trading in real time, exactly like a stock. You can buy and sell in seconds at the live market price. That flexibility is a double-edged sword. It gives you control, but it also tempts you to act like a trader, making impulsive moves when markets drop. Difference 2. Tax treatment. This is where it gets really important, and it depends heavily on your country. In Spain, index funds have a unique advantage called traspasabilidad, the ability to move money from one fund to another without triggering a taxable event. Your compound interest stays completely intact. With ETFs, every time you switch from one to another, you generate a taxable gain that you have to declare. Over decades, this can mean tens of thousands of dollars handed over to the tax authority for no reason. Outside Spain, the tax treatment varies, but the principle holds everywhere. Understand how your country taxes each instrument before choosing. So are ETFs worse? No, neither is universally better. What matters is which one fits your situation. ETFs are ideal if you want to invest in something very specific or niche. Think semiconductors, nuclear energy, or a specific sector. They also tend to have slightly lower management fees, perfect for the investor who wants full control and immediate access. Index funds are better for long-term, set-and-forget investors who want peace of mind and minimal tax friction. They're broader, less specific, but extremely powerful for building wealth over decades. The real mistake most investors make: people obsess over picking the perfect product. That's not the real problem. The real problem is investing without a system, changing strategy every 6 months, selling when the market drops 10%. An ETF in the hands of someone without discipline is a recipe for disaster. A worse index fund held consistently for 20 years will massively outperform a better ETF that gets sold every time there's a dip. Product choice matters, behavior matters more. 3-step action plan. Step 1. Think about your tax situation. Are you going to rebalance or switch products frequently? If yes, index funds are probably your best friend. If you're genuinely buying and forgetting for decades, ETFs might compensate with their lower fees. Step 2. Be honest with yourself. If having a real-time sell button available is going to make you panic sell when markets drop 15%, stay away from ETFs. Discipline is what makes you wealthy, not the product. Step 3. Diversify properly. It's fine to invest in specific sectors like semiconductors or clean energy, but keep it as a portion of a broader, globally diversified portfolio. Don't try to be Warren Buffett. He's taken. Choosing the right product is only the first step. The real question is when your portfolio starts to actually accelerate, and that's driven by consistency, time, and the compound interest curve working in your favor.